The world of decentralized finance rarely offers moments of pure, unambiguous consequence. It is often a swirling nexus of speculation, technical upgrades, and shifting narratives. But right now, for Uniswap and its Uni token, we are staring directly at one of those rare crystalline moments. The catalyst is a historic governance vote, and the clock is ticking with a finality that cannot be ignored. The decision lands in just 48 hours. This isn't merely another proposal in a long list of protocol improvements. This is the pivotal vote that could fundamentally redefine Uni value proposition from its core. The mechanism at the heart of this vote is as powerful as it is simple: the permanent removal, the burning of 100 million Uni tokens from circulation. To grasp the magnitude, consider the context. This isn't a small, symbolic gesture. We are talking about a deliberate act of digital scarcity engineering on a massive scale. This burn represents a direct attack on the circulating supply, a move designed to create a structural deficit where there was once abundance. The economic principle at play here is timeless. When demand meets a shrinking or static supply, the underlying asset's value proposition is radically altered. For Uni, which has often been criticized for a lack of direct, aggressive value accrual mechanisms, this burn is the answer. It transitions the token from a passive governance instrument to an asset with an embedded deflationary engine. However, the true sophistication and the critical nuance every investor must understand lies in the execution. This will not be a sudden, one-day explosion that vanishes tokens from wallets. The script correctly emphasizes a deliberate, methodical process governed by code. Imagine it not as a bomb, but as a furnace programmed to ignite and consume tokens at a predetermined steady rate. This design is intentional genius. A sudden single-event burn could cause a volatile, short-lived spike followed by a destabilizing correction. A programmed, time-released burn, however, creates a predictable, sustained pressure on supply over time. It gives the market a clear, forward-looking variable to price in. It allows adoption, usage, and demand to compound against a supply that is verifiably and irreversibly decreasing. This transforms the event from a speculative news headline into a hard-coded, long-term economic policy. The urgency of the 48-hour deadline amplifies the stakes exponentially. Governance in DeFi can sometimes feel abstract, a slow-moving debate among anonymous wallets. Not this time. This deadline imposes a hard stop, forcing a final collective decision from the Uni holder community. The sentiment leading up to this point, as evidenced by on-chain voting signals and the overwhelming consensus forming in forums and social channels, indicates a near-unanimous trajectory toward yes. The community appears to recognize this as the long-awaited mechanism to align the token's value directly with the protocol's staggering success. It is the missing piece in the puzzle. Stepping back, the philosophical importance of this vote cannot be overstated. For years, the value accrual question has been the central critique of many governance tokens. What good is governing a gold mine if you don't get a share of the gold? This Uni burn proposal is the definitive answer. By tying a reduction in token supply directly to the protocol's fee-generating activity through a clever, multifaceted mechanism involving V2 V3 fee switches and the nascent Uniswap chain, it forges an unbreakable link. The more the protocol is used, the more fees it generates, and the more aggressive the long-term deflationary pressure on Uni becomes. It creates a virtuous, self-reinforcing cycle. Therefore, this 48-hour period is not just a countdown to a vote. It is the threshold moment between two distinct eras for Uniswap. The first era was one of monumental product-market fit and growth, building a liquidity leviathan. The second era, poised to begin if this vote passes, is one of maturing value capture and refined economic design. It is the moment the protocol learns to not just create immense value, but to strategically, sustainably, and transparently funnel that value back to those who own and govern it. The burn is the mechanism, but the vote is the trigger. In 2 days, we will witness whether Uniswap's community chooses to pull it, unleashing a new economic reality for one of crypto's most vital assets. The countdown isn't just on the screen, it's ticking in the very code that could redefine the future of DeFi's flagship. The shift occurring with Uniswap transcends price action. It represents a fundamental evolution in how value is perceived, measured, and ultimately invested in. For years, even its most ardent supporters framed Univalue through a lens of potential and utility, governance rights over a critical piece of infrastructure. To traditional finance, however, it remained a cryptographic mystery, an asset whose fundamentals were opaque and whose valuation models were speculative at best. That era is conclusively ending. We are now witnessing the institutional re-rating of Uni, a process powered not by hype, but by the cold, hard, and utterly transparent logic of on-chain data. This transformation begins with the raw, unassailable metrics of the protocol itself. The numbers are so vast they border on abstraction, yet they are the bedrock of this new narrative. Over $4 trillion in cumulative volume has flowed across Uniswap's pools. To contextualize that scale, it eclipses the annual economic output of most nations. On Ethereum alone, Uniswap isn't just a leading application. It is the undisputed champion of value settlement, consistently ranking as the #1 protocol by fees generated. This isn't a fleeting victory. It's a demonstration of relentless market dominance. Each swap, every liquidity provision pays a toll, and that toll accrues directly to the protocol. This generates a revenue stream that is public, verifiable by anyone with an internet connection, and auditable in real time. We are no longer discussing potential revenue or business models. We are analyzing a live, profit-generating machine whose financial statements are written indelibly on the blockchain. This transparency dismantles the primary barrier to institutional adoption. The lockbox problem. A fund manager at a traditional firm cannot invest in what they cannot model. Previously, valuing required a leap of faith into network effects and future utility. Now it requires a spreadsheet. Analysts can treat Uniswap as they would any high-margin, scalable technology firm. They can project future fee income based on trading volume trends, apply a discount rate, and derive a net present value for the cash flows that accrue to the protocol. The governance vote to enable fee capture and the associated token burn directly links these cash flows to token holder value, making the model complete. As one prominent investor aptly noted, you could hand this data to an analyst at Goldman Sachs, and they could now compute a number. Before, the number did not compute. This on-chain verifiability also creates a powerful narrative of legitimacy and resilience. In a financial landscape still scarred by the failures of opaque, centrally controlled entities like FTX, Uniswap stands in stark contrast. Its operations are autonomous, its treasury is public, and its success is a function of code, not charismatic leadership. This trustlessness is no longer just a philosophical ideal for cypherpunks. It is a tangible risk mitigator and a competitive advantage in a skeptical world. It proves that a decentralized, collective enterprise can not only function, but can become the most efficient and reliable marketplace in its domain. The re-rating process is already visible in the market microstructure. The 97% consensus forming in the on-chain vote is not merely a measure of sentiment. It is a coordinated signal from the protocol's most invested stakeholders. These are entities and individuals with deep technical and economic understanding of the system. Their near-unanimous approval is a powerful Bayesian signal to the broader market, indicating that those with the most information believe this transformation will unlock significant value. This creates a feedback loop. Institutional interest increases liquidity and stability, which attracts more institutional interest, further validating the on-chain fundamentals. Ultimately, this keynote is about the collapse of a perceptual barrier. Uniswap is shedding its skin as a speculative crypto asset and emerging as what it has always been underneath, a global financial utility with a revolutionary business model. It is a toll bridge for the digital economy, and for the first time, the owners of that bridge are on the cusp of collecting the tolls directly and transparently. This is not a change in what Uniswap does. It is a seismic change in how the world values what it does. The on-chain data is the proof, and the market is finally learning how to read it. The mystery is solved, and in its place is a clear, investable, and verifiable cash flow engine. In the competitive arena of financial technology, advantages are often fleeting. Speed is copied, interfaces are cloned, and novel features become commoditized. True, lasting dominance is built on something far more formidable, a structural moat so wide and deep that replication becomes not just difficult but economically irrational. Uniswap is constructing such a moat, and its current expansion is not a mere growth spurt. It is the logical conquest of its total addressable market, transforming it from an Ethereum-centric application into the indispensable universal liquidity layer for the entire digital asset ecosystem. The first dimension of this moat is its devastating efficiency, a metric that renders traditional competitors obsolete. Consider the concept of volume per employee. Centralized exchanges like Coinbase or Binance are colossal organizations. They employ thousands, handling compliance, customer support, security, and platform development. Uniswap, in its pure protocol form, operates with a skeleton crew. Its employees are immutable smart contracts and an open-source codebase maintained by a relatively small team. Yet it consistently facilitates a volume that rivals and often surpasses these corporate giants. This is not just an interesting statistic. It is a revolutionary economic model. It means Uniswap's margins are structurally superior, its innovation cycle can be more agile, and its value accrual to token holders is not diluted by a massive operational overhead. In a competition based on capital efficiency and scalability, a centralized entity with payroll, offices, and legal teams simply cannot compete with a lean, autonomous protocol at scale. This efficiency is the fuel, but liquidity is the fortress. Uniswap's most powerful network effect is its deep composable liquidity pools. In finance, liquidity begets more liquidity. Traders and institutions go where they can execute large orders with minimal slippage. Developers build applications where assets are readily available. This creates a virtuous, self-reinforcing cycle. More users bring more liquidity, which attracts more users and developers, which deepens the liquidity further. Attempting to replicate this depth from scratch is a cold start problem of astronomical cost and difficulty. Any new challenger isn't just competing with Uniswap's code, they are competing against the billions of dollars of capital already comfortably earning yield within its ecosystem. This liquidity forms the bedrock of its interoperability empire. The current expansion to chains like Cardano, Solana, XRP, and others is not a defensive move or a dilution of focus. It is the masterstroke that turns a formidable fortress into an entire continent. Uniswap is executing on the profound insight that the future of blockchain is multi-chain, but the future of user experience must be seamless. No user wants to manage a dozen different wallets and interfaces for a dozen different ecosystems. By deploying its battle-tested V3 protocol across these diverse chains, Uniswap is positioning itself as the common denominator, the universal trading primitive. A user on Solana will swap Sol for a stablecoin using the same intuitive mental model and a nearly identical interface as a user on Arbitrum or Base. The underlying blockchain becomes an implementation detail abstracted away by a unified brand and experience. This expansion strategy neutralizes the one chain to rule them all narrative. It doesn't matter if Ethereum scales, if Solana wins the retail race, or if a new loan emerges. If it has a thriving ecosystem, Uniswap will be there, providing the core liquidity infrastructure. This makes Uni an agnostic bet on the growth of the entire crypto economy, not a partisan bet on a single chain's success. Its token becomes a claim on the fees generated from a sprawling, multi-chain financial network. Furthermore, this move preempts competition. By establishing first-mover advantage as the canonical DEX on each new chain, it replicates its network effects all over again. New applications on Cardano will naturally integrate with Uniswap v3 because it's where the liquidity already is. This creates a mosaic of interconnected liquidity fortresses, each strengthening the whole. The brand becomes synonymous with swap, Ultimately, this keynote is about the evolution from a product to a platform, and from a platform to a protocol standard. The moat is not a single feature. It is the synergistic combination of unparalleled capital efficiency, unassailable liquidity depth, and strategic, omnipresent deployment. Uniswap is no longer just an app you use on Ethereum. It is becoming the plumbing, the essential background infrastructure for value exchange across the entire cryptoverse. In this future, competing doesn't mean building a better DEX. It means convincing the entire market to collectively abandon the deepest, most efficient, and most widely available liquidity network in existence. That isn't competition. That is a fantasy. Uniswap is building the lattice upon which all other multi-chain DeFi will grow, and in doing so, it is cementing its role as the indispensable universal liquidity layer. Financial markets do not reprice assets in a linear fashion based on incremental news. Instead, they move in sharp, decisive leaps when multiple, previously disconnected vectors of value suddenly align, creating a moment of crystalline clarity, a convergence. For Uni, we are witnessing the formation of precisely such a convergence. This is not about a single bullish factor. It is about the synchronized arrival of four transformative catalysts that collectively create a perfect storm for a historic market re-rating. This process will not merely adjust Uni price by a percentage. It has the potential to redefine its entire market category and valuation paradigm. First and most immediate vector is the structural supply shock from the token burn. For years, Uni price action has been burdened by the overhang of its fully diluted supply and a perceived lack of aggressive deflationary mechanics. The 100 million token burn directly attacks this psychological and economic weight. It introduces a predictable, code-enforced scarcity that shifts the fundamental supply-demand equation. Markets price in the future, and a guaranteed, ongoing reduction in sellable supply against a backdrop of rising demand is one of the most powerful forces in finance. This alone is a significant catalyst, but its power is multiplied by its timing. It arrives just as Uni price breaks key multi-year technical resistance. This brings us to the second vector, the technical breakout from a prolonged accumulation phase. Chart analysis reveals a compelling narrative. Uni has spent years trading in a suppressed range, weathering bear markets and regulatory uncertainty. This lengthy period, often frustrating for holders, can be reframed as a massive, multi-year consolidation, a base-building exercise of historic proportions. The recent surge above this long-term resistance level is technically significant. It signals the potential exhaustion of selling pressure and the beginning of a new markup phase. In market psychology, breaking free from a well-defined range acts as a signal flare, attracting momentum capital and algorithmic traders who were previously. The burn vote provides the fundamental reason for the breakout, granting it legitimacy and sustainability beyond a mere speculative pump. The third converging vector is the institutional and regulatory clarity now coalescing around the protocol. For institutions, the previous barriers were twofold: a lack of a clear valuation model and regulatory uncertainty. As established in Keynote 2, the on-chain cash flow model solves the first. Concurrently, the evolving regulatory landscape, particularly developments like Wyoming's recognition of DAO legal agreements, begins to provide a framework. Uniswap's decentralized, non-custodial model positions it favorably within emerging regulatory guardrails aimed at curbing centralized malpractice. Furthermore, the explicit alignment of Uniswap Labs through binding agreements with governance demonstrates a maturation towards operational legitimacy that large capital allocators require. The protocol is no longer a rebellious experiment. It is evolving into a recognizable, albeit novel, financial entity that can be analyzed, endorsed, and allocated to within a professional portfolio. Finally, the fourth vector is the expansion of its total addressable market, TAM, as detailed in Keynote 3. The re-rating of a company or protocol often occurs when the market suddenly realizes its TAM is an order of magnitude larger than previously priced in. Uniswap's multi-chain deployment is that moment. The market is transitioning from valuing the leading DEX on Ethereum to valuing the liquidity infrastructure for all blockchains. This is a quantum leap in potential revenue streams and strategic importance. Each successful integration on Solana, Cardano, or Base is not just a new feature. It is an entirely new economy plugging into Uniswap's fee engine. The convergence of these four vectors, supply shock, technical breakout, institutional validation, and TAM explosion, creates a synergistic effect far greater than the sum of its parts. The supply shock makes the asset scarcer just as new demand from institutional models and multi-chain users emerges. The technical breakout confirms the fundamental shift, attracting capital that accelerates the move. The expanding TAM justifies a higher terminal value, while the regulatory maturation reduces the discount rate applied to that future value. This is the anatomy of a re-rate. The market is no longer pricing Uni based on its past as a governance token with uncertain utility. It is beginning to price it as a high-margin global financial utility with a deflationary token model, multi-chain dominance, and institutional-grade fundamentals. The gap between that new valuation paradigm and the old one is where the potential for exponential movement lies. All lines of this bullish thesis are not just pointing in the same direction. They are intersecting at this precise moment in time, creating the catalyst for Uni to shed its historical valuation constraints and be revalued on the basis of the formidable, future-proof financial empire it is becoming.